Hello and welcome to the CNBC-TV18's Mumbai studio. I'm Sonal Bhutra. With me as always is Pavitra Parekh here watching MF Corner. Well, you know, Pavitra, arbitrage funds, they've been in focus and they've seen steady inflows as well of funds for a while. In fact, January saw inflows of 10,608 crore rupees, which was a tad higher from the December figure of 10,645 crore rupees and a higher jump if we compare it to the month before. The flows have seen a strong level since the month of November last year. For our viewers, arbitrage funds seek to see profit on price differentials in the derivatives and the cash or the spot markets. These funds engage in simultaneous buying and selling transactions in cash and future markets, and that's how you make that spread. This category of funds are for new investors with a low risk appetite. So the question in this case arises that should you invest in these funds in a volatile market? Is current scenario right for this kind of investments? If yes, what makes this category worthwhile? And there's so much more to talk about this particular category.
Oh, absolutely. This is also one of the beneficiaries of the, debt tax changes, right? Because 65% is in equities and the rest is not. So on that front also, it's very interesting. But let's welcome our guest on the show now. We have Santosh Joseph joining us, founder and partner at Germinate Investor Services. Santosh, always a pleasure having you on the show. So thanks for taking the time and joining us today. But, like Sonal was pointing out, at a time like this when the market has already run up so much, but there is expected to be heightened volatility, specifically in the broader markets. Do you think that arbitrage funds look specifically good at a time like this? Because we have seen inflows going up month after month.
Hi, good afternoon. So good to be back with both of you. Now, it's nice that we're covering arbitrage funds and they have done well, both in terms of the performance and even in terms of the flows. Pavitra, you pointed out to a very important aspect of the benefit of taxation that actually makes arbitrage funds extremely lucrative right now. So the flows here do not necessarily matter as long as you're able to get that yield spread captured in. Right now, the very yield spread that one is looking at being able to capture in the arbitrage is looking extremely lucrative for an investor to consider. Positive taxes, positive yields, both are a great opportunity for investors to look at this, and this actually opens up a beautiful alternative for people who are looking for liquid money market and ultra short term, but had a little bit of extra time frame to consider. So this actually ticks all the boxes there, and good time to consider.
Okay, so it's a good time to look at arbitrage funds, and I think that's what investors are looking, considering the flows picture in this particular segment. So in that case, Santosh, who should invest in arbitrage funds, and what is the time horizon that they should look at?
So therefore, arbitrage does not constrain any kind of investor as long as you are sure that this is a short-term investment, because what happens is you can't come into an arbitrage thinking it's equity and wait for long-term, because you'll be then disappointed if the market runs away. If you're a short-term investor, this is a great step up compared to a liquid or a money market fund, because if you're going to consider at least a 3 to 6 months time horizon, you are going to be rewarded with a slightly better yield, effective of taxes, post-tax return, a much better yield. So therefore, if you have an investment horizon of 3 months or more and 6 months, great. If you can make it 12 months, your post-tax yields get even more sweeter.
Okay, so that is on the kind of time horizon that you can look at. Just take us through what the performance has been as well, and if you could sort of peg that against the benchmark.
So let's just look at the last 6 months, and that's the most relative time that we're looking at. A typical arbitrage fund has generated 6.5 to 7.5. And some of the guys have even gone beyond 8% annualized return on a 6 months basis. Now, look at the benchmark, which could possibly be a liquid fund or maybe even the 10-year or even a typical money market fund. They've all maybe delivered about 0.5% or 0.75% lower. Now, add a layer of post-tax return to that. Now, when you add the post-tax return, that's when it gets sweet, because in an arbitrage fund, the investor pays a short-term capital gain on equity of 15%. The minute you calculate the post-tax returns, there's almost 0.5% to 1.5% differential on arbitrage funds, even for a short-term investment of like 6 months. Now, compare that to a FD rate, compare that to the 10-year GSEC or even liquid arbitrage funds have a nice 1.5% extra return that you can make post-tax.
Okay, all right. So, ultimately everyone looks at the returns post taxes, right? Because that's what comes in their hands. But we get it. This is what the taxation picture looks like as well for arbitrage funds. But we have to understand, and the viewers as well, right? Because it's simultaneous buying and selling, and you are giving this money to a fund manager. Are there any risks associated with this that any investor should be aware of?
See, there is going to be a little bit of short term, maybe a week or 10 days, when the simultaneous buying and selling has to, produce value into the particular fund. So therefore, if you're going to be an extremely short term investor, like for 15 days or 13 days, then maybe this is not the best option for you. Also, please keep in mind that typically an arbitrage fund would have a 30 days exit load. So be careful of the 30-day exit load. Also, that in a 30 to 45-day time, you may get the raw end of the arbitrage opportunity. But if you're going to come with a 1 to 3 month perspective, by and large, those volatilities that you have between trading in the cash and the futures or the spot markets, this get ironed out. So I think the best way to be taking the most of this volatility is just stay invested for at least a 2 to 3 month period, and those will get ironed out automatically.
All right, got that. Santosh, we have a lot more questions on arbitrage funds and on other categories as well. So we're going to get to that in just a bit. But for now, we do need to get into a short break. We'll be back in 2 and we'll continue this conversation with Santosh. Stay tuned.
How much time is left? How much time is left in
They
second
have the
two?
bars.
Hey Santosh, hi. So we
Hi.
have around 4 questions left with 13 minutes. So we'd request you
Yes.
to keep your answers a little longer and
Great.
explain anything.
Welcome back. You're still tuned into MF Corner, and we're speaking with Santosh Joseph on arbitrage funds and how you really go about picking them, the big advantages as well. So, Santosh, there are many arbitrage funds available, of course. How do you pick from all of these funds that are on offer? Are there some, parameters that you should be comparing? And do you have any favorites? If you were to recommend some to us, what would those be?
Though arbitrages are a fairly simple product, still makes sense to go with the guys who have a proven track record. Now, I think over the many years, we've seen that there are few fund houses which have a proven track record. Maybe they have an extra analyst, or we have an analyst who understands the arbitrages options available between the cash and the spot markets and the derivative markets. You know clearly that there are guys who are outliers in this space. So number one, go with a fund house that has got a proven track record and have the strength of managing the arbitrage opportunities, because there are some who have an arbitrage fund, but they're just running it normally. Second, also go by the vintage and the size of the fund. A fund which has got a longer vintage and has also got a larger size is also testimony to the fact that one, they know how to manage it. Two, they've got consistent flows. And three, they also got returns to show forth. Now, the favorites here come along are the same as what I just mentioned. The guys who have actually proven this. My favorites are maybe Kotak, Tata, Edelweiss, and even Bandhan Mutual Fund. Now, if you notice, these 3-4 names that I spoke about are actually some of the largest in the category. They also are consistently doing well above the peer group, and they also are able to capture the arbitrage opportunities at the forefront of this game. Now, clearly, it shows that they got strength in this space.
Yeah, all right. So we take that point. This is something that you should keep in mind while you're investing in arbitrage funds, the proven track record, as Santosh was just mentioning. But are these expensive? Do we see higher churn here? How can one look at the expense side of this particular category?
Yeah, I think regarding the churn and the movement within the portfolio, I think we cannot look at it from a standalone equity fund, because there is going to be churn. In fact, in most times, they'll be trying to lock in the opportunities or the buying and selling on a month-on-month basis. So therefore, you will see a lot more volatility on a daily basis, a lot more churn on a regular basis, because that's the core objective of the fund, is to capture the arbitrage opportunities. Now, having said that, what are the expense ratios? Now, the lowest or the most economical of the entire arbitrage category is at about maybe 60-65 basis, and the most expensive, or the most highest expense ratio, the TER, would be about 110, 115 basis possibly. So you see the range is between 60 to 100, 110 broadly. Now, considering the returns that they provide on a post-tax basis is the most important fact that investors have to keep in mind, because expense ratio could slightly vary by 20-30 basis, but are you capturing that kind of return, and post-tax, are you making enough to justify even that expense that you're paying for? So I would not essentially worry on expense ratio alone. I would be looking at, irrespective of the expense ratio, what is my post-tax yield the fund has given me, post-expense yield the fund has given me, and therefore eventually the post-tax returns.
Okay, got that. So you definitely do need to calculate the post-tax returns. But Santosh, you want to take us through, how arbitrage funds are taxed? I know we briefly touched upon this, but just take us through how these products are looked at in terms of taxation.
Well, to begin with, arbitrage funds enjoy the benefit of equity taxation. Now, we know equity taxation is if the underlying investments are in equity to the extent of 65% or more, you get the capital gain benefit, which is long-term and short-term of equity. The long-term equity is 12 months or more. Short-term equity is 12 months or less. Now, when you invest in an arbitrage fund and complete the 365 days or 12 months, you pay 10% long-term capital gains. And keep in mind, up to ₹1,00,000 of capital gains in a particular year long-term are tax-free. Now, if it's short-term, if it's less than 365 days or 12 months, then you pay 15%. Now, you have to compare that with the fixed income for debt mutual funds or fixed income mutual funds, or even the bank FD, which investors traditionally like to compare. Both are at slab rate or a business income tax rate, which means that straight away for a less than 12 months investor, the tax advantage is huge. Now, if you're going to consider 12 months or more, then the deal gets even sweeter, because you only pay 10% of long-term capital gains. You also get reasonably decent yields. So that's why the taxation from an arbitrage fund perspective is a huge winner.
Okay, all right. So it is about taxation. We've covered that. We've covered the returns that these kind of funds, return to the investors, and of course, who can go ahead and invest in this particular category. But Santosh, how do you compare these with, say, short-term funds, otherwise, say, liquid or money market funds? Can we compare these two first up, or do you think these are two very different categories?
Well, they have very little similarities, and I'll begin with the similarities first. Now, both are for short-term parking. Usually, when an investor does not want to take a directional call, both in fixed income or in equities, that's when you park in either short-term or arbitrage. Now, when you park it in short-term, you're either taking a call on liquid, overnight, money market, or to some extent, even some ultra short-term funds. Now, when you compare the same thing with this arbitrage funds, you're saying, hey, I don't know any of the fixed income categories. I'm going to be in the equity arbitrage short term. So therefore, there is no easy apple to apple comparison between the fixed income variant and the equity variant. Now, where it gets interesting is that in the fixed income variant, the yields sometimes tend to be in line with the arbitrage fund. And as we discussed extensively, the taxes actually, trump on the arbitrage fund side. Now, when you look at sometimes in the really short-term frame, you'll notice that the time we are in right now, that the arbitrage short-term rates are so lucrative and so interesting that then people tend to ignore the liquid and the money market or short-term. So therefore, it's also so critically contingent upon the yields in the arbitrage funds that they're able to capture so that the investor can take a call from time to time. Right now as we speak, there is a bit of tightness in systemic liquidity. Therefore arbitrage funds are favorable. You can't compare it to fixed income, and they're a little more different in terms of even the exit loads, even the redemption time frame. A typical short-term fixed income product, you redeem today in T+1 settlement, the money is in your bank account. Whereas in the arbitrage fund, you have to keep in mind it is still an equity fund. It needs the T+2 settlement for the money to come back. So it's also the combination of liquidity. If you're used to a one-day redemption cycle, then still you may have to consider liquid or money market. But if you are okay with a little bit of extra time that you sacrifice on liquidity, which is a day or two, then arbitrage funds come into the play.
Okay, very interesting. And I'm sure, this category is one of those which almost everybody can look at and consider investing in. Santosh, I want to move on to a very different topic now. This is news that came through last week, which is that SEBI has written to AMFI and they are directing mutual fund trustees to come up with a plan to protect the interests of mutual fund investors. This is specifically for small and mid caps. Take us through what you really make of what they have said, because what they have suggested for now is that mutual fund houses should moderate inflows. They should maybe look at rebalancing the portfolio. How much do you think of this? Do you think it's really feasible? And what else can be done to protect investor interest? Because the rush into these categories has been real.
Well, I think this is a move by SEBI on the back of massive flows month on month, quarter on quarter for the last year or so. Now, sometimes it's so surprising to see that small caps and mid caps have beaten dominant categories like diversified equity funds or maybe even traditional multi-cap and flexi-cap funds. Now, many investors are clearly chasing returns and coming into the fund not knowing what could hit them. So therefore, I would believe that SEBI's action towards this small and mid-cap category would largely be on a protective side to make the investor, and especially the retail investor, be aware that it's not an easy access to make quick returns by being in the mid-cap and the small cap. It's got its own set of risks. Though the last 1 year has been extremely rewarding, it is not indicative of the future in any sense. And from a fund perspective, when the funds become really large, the question is, do the stocks that the fund's investing in have the capacity to absorb that large amount of inflows? Because what's happening is now we are in almost a self-fulfilling prophecy where the funds are doing well, you get more money, you invest more money in the same stocks, and the stock prices keep going up. I think that is where SEBI is trying to address the problem by making investors and mutual fund companies being a little more cautious on why the flows are coming and how to moderate expectations and make the retail investor be a little more informed.
Okay, no, that makes sense, because at the end of the day, somebody who's taking exposure to small caps and mid caps via funds is also seeing those elevated levels right now in terms of valuations. A lot of these funds have stopped taking new inflows as well, maybe via lump sum or SIP as well. Santosh, in this case, how are you looking at the mid cap and the small cap space right now, the fund flows, because we will be getting the February flows as well. We are also nearing the year end. How are you looking at the entire space when it comes to valuations vis-a-vis the large caps and in general?
So clearly, one, on the flows. I think when the Feb numbers come, you will. There's no surprise that even Feb numbers are going to be as big or maybe even greater than the December and January flows. Like I mentioned earlier, clearly it's a function of performance. And when people compare to a large cap fund, to a multi cap fund, to a mid and small cap fund, there is a huge delta there. And therefore, people think that I rather buy a fund which has got 20-30% higher performance than the fund which is lower by 20-30%. That's number one. Number two, I believe that at some level, there has to be a normalization. Now, I'm not saying that the story or the juice in the mid cap and small cap is over. What I am saying is that the repetition of what we've seen in the last year or so may not be easily repeatable. Now, this is something that may be a kind of a hard landing or difficult thing to digest for retail investors, because they've come on the hopes of high return. Now, any return less than the high hopes they've come is, of course, going to disappoint. Now, not to forget that if those expectations are not met, rather there's a pause in the small and mid cap or even a correction, I think many investors will not know even how to handle this sort of an experience, because they've come on the back of great returns. They've come expecting even greater returns. And if there is going to be a disappointment, I think many will then flee as fast as they came. And therefore, all the surveillance mechanism right now is to, keep people reminding of how the small and mid cap space is generally is. It's exuberant to the core when things are going well, and it becomes really, dampening and very sad when things take a downturn.
Santosh, just going back to my previous question, I mean, there's no question, right, that SEBI does need to do something to protect investor interest. What I'm asking you is, what do you think they should do? Because moderating inflows, asking to rebalance the portfolio, these are not small things. It can be very disruptive for the market, even if you stagger it out over a 3-month period or whatever. And how do you protect investors from the first mover advantage? So what do you think are the steps which are actually feasible to take?
First things first, sometimes, these things can't really be controlled by even the regulator, because see, clearly we had the SEBI scheme recategorizations, which clearly mentioned what is a small cap, what is a mid cap, what is a large cap. Now, when you look at the flows, in spite of the fund name being very specifically small cap and mid cap, people are just, making fresh investments in big numbers. Now, though we have categorization already, put in place to avoid misunderstanding of the scheme category, even then investors are pouring in money. Now, at some level, one cannot stop the retail exuberance and the frenzy of wanting to be there, and self-admitting that they're willing to take the risk. In fact, the riskometer also very clearly tells you that this is a high risk product. Also, when you look at the categorization, this is the small cap which is more aggressive than large cap. Purely from a valuation perspective, we know large caps are doing well, but people are chasing returns. Now, one way that the regulator can possibly help is show what happened in the previous downturn. Right? When you show what happened in the previous downturn, it looks good. Now, I'll tell you where the catch is. On a 1-year basis, there's a huge delta between the market index and large cap index. Even when you take a 10-year basis, the average small cap return on a 10-year basis is in excess of 20%. Let me put another statement in conjunction here. The worst performing small cap fund on a 10-year basis has done significantly better than the best performing large cap on a 10-year basis.
Okay.
So the 10-year and the 1-year conjunction makes people believe that small cap and mid cap is the way to go.
Yes, Santosh, we get that point, and we'll have to see how things pan out when it comes to small and mid caps. But thank you so much for joining us today and giving us your take on arbitrage funds and a lot more that's happening in the mutual fund industry. With that, we'll do one thing. We'll take your leave on this edition of MF Corner today, but stay tuned for Closing Bell to take you through the last hour of trade.